Ever wonder why the stock market crashes, seemingly out of nowhere? It might feel like a sudden storm, but there are actually several key factors at play that can trigger these dramatic drops. First, consider investor psychology. Markets are driven by emotions, such as fear and greed. When investors start to feel anxious about the economy or a specific sector, they often sell their stocks en masse, creating a domino effect. Imagine a crowded theater where someone yells fire, everyone rushes for the exits, even if there's no real danger. This panic selling can lead to a rapid decline in stock prices. Then there's economic data and news. Economic indicators like unemployment rates or inflation numbers play a huge role. If reports show that the economy is slowing down or inflation is rising too quickly, investors might worry that company profits will take a hit. Think of it like a car running out of gas. If you know the economy is sputtering, you might not want to invest in stocks that could lose value. Another contributor is market speculation, where traders make assumptions based on trends or rumors rather than solid information. When everyone jumps on a trend, a bubble can form. Once it pops, the crash can follow swiftly. Imagine a bubble slowly swelling. If someone pokes it with a pin, it bursts instantly, just like stock prices can plummet when speculation goes wrong. Lastly, external shocks, like geopolitical events or natural disasters, can also lead to sudden market declines. These unpredictable events can shake investor confidence and cause widespread selling. In summary, stock market crashes aren't random. They're often the result of a mix of investor emotions, economic indicators, speculation, and external shocks. Understanding these factors can help demystify why the market can plummet seemingly overnight. If you found this insight helpful, consider subscribing for a clearer understanding of the markets. Ever wondered how investor sentiment can trigger a stock market crash? It all boils down to psychology. When fear or panic sets in, it can cause a domino effect that leads to massive sell-offs. Picture this: you're in a crowded theater, and someone suddenly yells, "Fire." Instantly, everyone's instinct is to rush for the exits, even if there's no actual fire. That's exactly how fear works in the stock market. When investors start to lose confidence, perhaps due to bad news about the economy or political instability, they begin to panic. They think, "I need to sell my stocks now before they lose even more value." This rush to sell creates a flurry of selling activity. The mechanics of this are critical. As more people sell, the prices of stocks begin to drop. And here's the surprising part: when stock prices start to fall, it can trigger even more fear. Now think of it as a snowball rolling down a hill, but as it gathers momentum, it grows larger and larger. In the stock market, this is often referred to as a market correction. But during severe cases, it can spiral into a crash. The more prices drop, the more panic spreads. Investors fear they'll miss the chance to salvage their investments, leading to even more selling. Ultimately, it's this cycle of fear and rapid selling that can send the market into a tailspin. In summary, investor sentiment plays a crucial role in market crashes, where fear can quickly overshadow rational decision-making. So the next time you hear of a market downturn, remember, it's often driven by emotions as much as it is by numbers. What role do economic indicators play in a stock market crash? Think of economic indicators as warning lights on your car's dashboard. When the gas light flickers, it doesn't mean you'll run out of fuel right away, but it's a clear signal that you need to pay attention. Similarly, when unemployment rises or inflation spikes, it signals potential trouble ahead for the economy. Imagine you're driving along and that gas light comes on. You might choose to ignore it, believing you have enough fuel to reach your destination. But what if you drive too far? You risk running out of gas, just like investors risk losing money if they ignore those economic signals. When investors see negative indicators, like increasing unemployment rates or rising inflation, they often react quickly. They worry that these signs mean the economy might be slowing down, leading to reduced consumer spending and lower corporate profits. So what do? They start selling off stocks, fearing that the market will drop as economic conditions worsen. Here's the surprising part: this reaction can sometimes create a self-fulfilling prophecy. As more investors sell their stocks, prices drop, and that can amplify the panic, leading to even more selling. It's a snowball effect. In this way, economic data doesn't just inform investors, it influences their actions, which can trigger a crash even if the underlying economy isn't as bad as it seems. So keeping an eye on these economic indicators is crucial. They can provide vital clues about the health of the economy and help investors gauge when to be cautious. Understanding this relationship between economic data and market sentiment can help you see how the stock market reacts even before a crash happens. Why does leverage play such a crucial role in market crashes? Imagine you're building a Jenga tower. Each block represents an investment, and your goal is to reach new heights. Now, to make your tower taller faster, you start borrowing blocks from a friend, promising to return them later. This is leverage, using borrowed money to amplify your investments. At first, it works beautifully. Your tower grows taller, your gains increase, and it feels exhilarating. But here's the catch. As the market starts to decline, the situation changes dramatically. Those borrowed blocks become a liability. If the tower wobbles even slightly, your friend might demand their blocks back. This is called a margin call. When investors face margin calls, they're forced to sell their assets to cover those borrowed funds. This is where the Jenga analogy really hits home. As you pull out blocks to stabilize your tower, the whole structure becomes weaker. If enough investors start selling to meet their margin calls, it creates a domino effect, causing prices to plummet. The market can spiral downward rapidly, just like a Jenga tower collapsing when too many blocks are removed. And here's the surprising part. During a downturn, the very leverage that once helped investors amplify their returns can now amplify their losses. In a healthy market, leverage can be beneficial, but in times of stress, it transforms into a catalyst for crashes. So, understanding how leverage operates and its potential risks is crucial for anyone looking to navigate the stock market. When you look back at a market crash, remember that the power of leverage can either build great heights or lead to a sudden collapse. Have you ever wondered how the stock market can suddenly plummet, seemingly out of nowhere? A significant factor is the role of algorithms and high-frequency trading. These computer programs are designed to analyze market data and execute trades at lightning speed, often in milliseconds. Imagine a row of dominoes set up perfectly. If you tip the first one, it falls and knocks down the next one, and then the next, until the whole line collapses. In the stock market, algorithms can act like that first domino. When they detect a small drop in stock prices, they can trigger an automatic sell-off. One programmed response leads to another, creating a domino effect that amplifies the market decline. For example, when a stock price dips even slightly, these algorithms can sell thousands of shares almost instantly. It doesn't matter if the drop is temporary, the algorithms are programmed to act quickly and decisively. This rapid selling can scare human traders, who may panic and start selling their own shares, further pushing prices down. The result? A sharp, cascading drop in the market. And here's the surprising part. This process can happen even when the underlying fundamentals of the companies haven't changed at all. The algorithms react to price movements, not the health of the business. This is why understanding how these mechanisms work is crucial. It shows us that sometimes market crashes are not just about what's happening in the economy, but also about how technology is driving the trading landscape. So next time you hear about a market crash, consider the role of these algorithms. They can turn a minor downturn into a full-blown sell-off faster than you might think. If this new perspective on market mechanics intrigues you, hit that subscribe button for more insights. Why do stock market crashes happen? It's a question that captures the anxiety of many investors, and the answer is a blend of emotions, economic signals, and technological factors. At their core, stock market crashes are complex events driven by a volatile mix of investor sentiment and fundamental economic indicators. When fear takes hold, often triggered by bad news or unexpected events, investors start to panic and sell off their holdings. Imagine a crowded concert where someone screams fire. In an instant, everyone rushes for the exits, causing a stampede. This is similar to what happens in the markets. A wave of selling can quickly escalate, driving prices down further and faster. But it doesn't just end with panic. Leverage plays a critical role too. When investors borrow money to buy more stocks, they amplify both their potential gains and their losses. If the market starts to decline, these leveraged positions can force traders to liquidate their assets to meet margin calls, pushing prices down even more. It's like a row of dominoes. One tipping can lead to a cascade. And here's the surprising part. Technology amplifies all of this. With algorithms and high-frequency trading, stocks can be bought and sold in milliseconds, creating a feedback loop that can exacerbate rapid declines. The more people sell, the more automated systems react to the plummeting prices, leading to further selling. By understanding these mechanisms, you gain insight into why stock market crashes happen and how they unfold. They're not just random events. They are the culmination of various forces at play. If you found this enlightening, consider subscribing for more insights into how the markets really work.